Today, we're diving into the exciting world of swing trading with a special focus on technical indicators. How you can use technical indicators to spot those elusive market downturns before they even hit your portfolio like a wrecking ball. I'm Kevin, and whether you're a seasoned trader or just starting out, understanding these signals could be the difference between watching your investments grow or painfully evaporate during the next recession, which is probably right here, right now. Before we jump in, I'm an enthusiast sharing knowledge. Always do your own research before making investment decisions. That said, let's get started. We'll break down what are technical indicators, how to use them, and zoom in on some key signals that could warn you about a recession or a bear market. First things first, what's swing trading? Imagine you're surfing the stock market waves. You're not in it for the long haul like a buy and hold investor, and you're not glued to your screen day trading like a caffeinated squirrel. Swing trading is about catching those medium-term swings in stock prices. It's all about timing, and that's where technical analysis comes in. Unlike day trading, where positions last hours, minutes, or long-term investings where you might hold for years, swing trading captures swings in the market over days or weeks. It's that sweet spot between hyperactive day trading and set it and forget it. Swing traders look for opportunities where momentum is building in one direction, hop on for the ride, and jump off before the trend reverses. The goal? Capture a chunk of the move and then move on to the next opportunity. So what's technical analysis? Think of it as being a detective for the stock market. It's like reading the market's mood swings using charts and data. Instead of focusing on a company's fundamentals like earnings or management, technical analysis studies past trading activity and price changes to predict future price movements. It's based on three key assumptions. 1. Market action discounts everything. All known information is reflected in the price. Number 2, prices move in trends. And number 3, history tends to repeat itself. Technical analysis uses charts and various indicators to identify patterns that might signal where the market is headed next. We're looking at price patterns, trends, and indicators to predict where a stock might go. Think of it as the market's heartbeat, and technical indicators are the stethoscope. Let's talk about some must-know indicators that every swing trader should have in their toolkit. These are like the spices in your trading recipe. They add flavor and help you cook up better trades. Let's look at some popular technical indicators. Number 1, moving averages. These smooth out price data to create a single flowing line, making it easier to identify the direction of the trend. Picture a line that smooths out a stock's price over time, like a 50-day or 200-day moving average. It helps to spot trends. If the price is above the moving average, things are looking bullish. Below, kind of bearish vibes. Number 2, Relative Strength Index, RSI. This measures the speed and change of price movements on a scale from 0 to 100, helping identify overbought or oversold conditions. This is your speedometer. RSI measures if a stock is overbought, above 70, that's maybe too hot to handle, or oversold, below 30, and maybe a bargain. It's great for spotting when a swing might reverse. MACD, Moving Average Convergence Divergence. Sounds fancy, but it basically shows the relationship between two moving averages of a security's price. It's just two moving averages dancing together. When they cross, a signal to buy or sell. It's like the market whispering, hey, something's about to happen. 4, Bollinger Bands. These create a price channel that the asset normally trades within, helping identify when prices might be extreme. But today, we're going to focus on two particularly powerful indicators that can help spot looming recessions and bear markets. Now let's get to the juicy stuff. Indicators that scream warning, bear market or recession ahead. These are the ones that make swing traders sit up and pay attention. First up, the death cross. Spooky name, right? It's when a stock's 50-day moving average crosses below the 200-day moving average. It's like the market saying, uh-oh, things might get rough. Houston, we have a problem. This is a classic signal of a potential bear market where prices could keep sliding. For swing traders, spotting a death cross might mean it's time to sell or even short a stock, betting it'll drop. But here's the catch. It's not foolproof. Sometimes the market fakes us out, so always double check with other indicators. This indicator has predicted many major market downturns, including the 1929 crash, the 2008 financial crisis, and the 2020 COVID crash. It works because it shows when short-term momentum has decisively turned negative compared to the longer-term trend. But here's the catch. It's not perfect. Sometimes you get a false cross where the market quickly recovers. That's why smart traders use it alongside other indicators, like our next contender. Now let's talk about a leading indicator of a recession that's not on your typical stock chart, the yield curve inversion. The economist's crystal ball. Now for the heavyweight champion of recession prediction. The yield curve inversion, specifically when the 2-year Treasury bond yield rises above the 10-year bond yield. In normal times, you expect to get paid more interest for locking your money away longer. Think about it. Would you lend money to your somewhat unreliable friend for 10 years at the same rate as 2 years? Probably not. You'd want compensation for that extra time and risk. When short-term rates rise above long-term rates, it signals that investors believe the near-term economy is riskier than the long-term outlook. Essentially, they're saying things are about to get rough. This indicator has successfully predicted every U.S. recession since 1955, though with varying lead times, typically 6 to 24 months before the recession begins. That's an impressive track record. When both the death cross appears and the yield curve is inverted, the probability of a significant market downturn increases substantially. Add in other confirming signals like declining market breadth, fewer stocks participating in rallies, or rising volatility, and you've got a pretty compelling case for caution. Think of it like weather forecasting. One dark cloud doesn't mean a storm is coming, but dark clouds plus dropping barometric pressure, strong winds, and radar confirmation, time to bring the umbrella. Let's look at a real example from recent history. In late 2019, parts of the yield curve had already inverted. By February of 2020, as COVID concerns mounted, we saw death crosses forming across major indices, volatility spiking, and market breadth deteriorating rapidly. Traders who spotted these signals early could have taken profits on long positions, added hedges to their portfolios, positioned for the eventual recovery by preparing a shopping list of quality stocks at discount prices. These indicators aren't magic. The death cross sometimes comes too late, after much of the damage is done. And while the yield curve has an impressive prediction record, the timing between inversion and recession varies widely. Also, unprecedented factors like massive central bank intervention can distort these signals. The Federal Reserve's quantitative easing programs have fundamentally changed how some of these indicators work compared to historic norms. The smartest swing traders don't just look at charts. They combine technical signals with an understanding of the broader economic environment. Ask yourself, what's happening with inflation and interest rates? How strong is the labor market? Are corporate earnings growing or contracting? What's the sentiment among consumers and businesses? These fundamental factors provide context for the technical signals you're seeing. So where do you go from here? Set up your charts to track both the 50-day and 200-day moving averages on major indices, and also use a shorter average such as a 10-day. When things get volatile, switch your charts to a 4-hour window versus a 1-day. Bookmark a reliable financial site that shows the yield curve regularly. Practice identifying these patterns on historical charts. Use proper position sizing and paper trading tools, not real money. Keep a trading journal to record what signals you saw and how the market responded. Test your strategies without risking real money. Stay disciplined, stick to your plan, even when emotions are screaming. Keep learning. The market's always changing, so stay curious. Remember, no indicator is perfect, but when multiple signals align, it's worth paying attention. As the saying goes, the trend is your friend until it isn't. Recognize when trends are changing is key to preserving capital and finding new opportunities. If you found this helpful, smash that like button and subscribe below for more trading insights. Drop your questions in the comments and let me know what technical indicators you find most useful in your trading journey. Until next time, happy trading, keep those charts closed, and I'll see you on the next one.